Most investors panic when the market crashes, but every crash holds the biggest opportunity to build wealth. The market always comes back, no matter how bad the fall was. Every time the market falls 20%, people think it is the end. They hesitate, freeze, and miss out. Smart investors, they know a powerful truth, one that practically guarantees for them profits by knowing when to act. In this video, I am revealing the profit from the pit framework, a simple proven way to flip the market drop into your biggest opportunity. And I will show you why the market always reclaims its peak and how you can position yourself to ride the comeback for a massive gain. If you skip this part, you will regret it the next time the market falls. So stay till the end because this could be the most powerful investment lesson you will hear. Imagine this. You check the markets one morning and everything is in red. The index is crashing. Your portfolio is down 20%, 30%. News anchors are screaming. Twitter is full of meltdown mode. Your heart sinks. Should I sell before it gets even worse? What if this is the next 2008 crisis? Will the market ever recover? This is the exact fear that has paralyzed investors again and again throughout history. And every single time, those who panicked sold in losses, while those who understood what I'm about to show you made a fortune. Let us analyze this recent market correction through the profit from the pit framework, and let's see how we can apply it whenever the market drops from the peak. If you enjoy creative content that breaks the clutter and gives you actionable insights like an investing lesson, please consider liking this video and subscribe to this channel. Your support motivates me to do more research and share more. In 2008 global financial crisis, the market collapsed more than 50%. People thought this was the end. The entire financial system was on the verge of collapse. Banks shut down. Stocks were on a free fall. Investors dumped their holdings in panic, thinking markets would never come back. Now, if you look at this chart, the market dropped nearly 59% over a span of 420 days before hitting the bottom. But here's the interesting part. When the market recovered just back to the same level, the return for those who stayed invested at the bottom was a massive 130%, and it took 600 days to get there. Now, sometimes the recovery is faster than the fall, other times it takes longer. Mathematically, one thing is certain. The percentage gain required to reclaim the peak is always greater than the percentage lost. This is why every deep correction sets up an even bigger comeback for those who stay invested, or better yet, invest at the bottom. From October 21 to June 22, the market fell 18% for a span of 8 months before hitting the bottom. But here's what's fascinating. Any investment made in June 22 at the lowest point would have gained 22% when the market reclaimed its previous peak. And that recovery took only 5 months. However, there are two critical blind spots that investors often overlook. Recovery time is unpredictable. In this case, the fall took 8 months, but the rebound happened in 5 months. Other times, it can take even longer to recover than it did to fall. This means the annualized return varies. The time factor is beyond our control. Second is the illusion of perfect bottom. While looking back, the bottom seems very obvious, but during the crash, investors never truly know if they are at the bottom. Are we at the lowest point today, or could the real bottom be weeks or months away? You will only know this in hindsight. And that's why timing the market is nearly impossible. Instead, understanding how market recoveries work can help you make smarter, more confident investment decisions. Now, here is where profit from the pit framework comes in handy. The entire concept is based on simple yet powerful mathematical fact. Whenever the market falls and then reclaims its peak, the percentage gain on the way back up is always greater than the percentage lost. For example, if the market drops 20%, A recovery back to the same level requires 25% gain. If it falls 30%, a 42% gain is required. Extreme cases, 50% crash, market must double, 100% gain just to get back to where it started. This is why deep corrections create outsized opportunity. But here is the key assumption that drives the strategy. The market will always go back to its peak. The big question is this guaranteed? This is where most investors hesitate. Sure, we have seen the markets recover time and time again, but is there a guarantee? What if this time it is different? What if the market will never come back? To answer this, we need to go a bit deeper into history, economics, and the fundamental engine that is driving the markets higher over time. Because once you understand why markets always reclaim their peak, you will never fear a market crash the same way again. And that's exactly what I will break down next. So, why does the market always reclaim its peak? The answer lies in one fundamental truth. Markets move in sync with corporate profitability. Over time, stock prices are driven by two key forces: actual earnings growth and the expectation of future earnings growth. While short-term fluctuations are influenced by macroeconomic factors, global factors, liquidity, investor sentiment, the long-term trajectory of the market is determined by how much these companies' earnings are growing. Take a look at this chart. Over the last 5 years, earnings per share of the Sensex companies has grown at an impressive 17% CAGR. Just as expected, the market has closely followed suit, delivering 15% annualized return. This is no coincidence. Stock prices over the long run are a direct reflection of earnings growth. Now, we have established that markets follow corporate earnings growth over the long term. But here is where it gets very interesting. Markets don't always go up smoothly. There are phases where they surge ahead of the earnings and phases where they stagnate or correct. Now, if you look at this chart, it's clear that over the long term, the BSE Sensex EPS green bars and the Sensex blue line have moved in tandem. Corporate earnings have grown at 12.5% CAGR since 93, and Sensex return have also aligned with this 12% CAGR. This means the fundamental driver of stock prices is earnings growth. Market will ultimately follow profitability and economic expansion over time. When the market struggles to deliver returns, let me share some key insights about it. Since markets don't move in a straight line, when the stock prices surge far ahead of the earnings, a period of stagnation or correction will follow. Now, looking at this chart, there are clear moments when the Sensex index shot well above the EPS growth trend. Those were the times when investor optimism drove stock prices beyond their fundamental value. Historically, such phases, markets either undergo a correction or a price adjustment back to align with earnings growth, or it gets into an extended period of stagnation, going sideways until the earnings catch up. Now, will India face a lost decade like Japan? Many investors fear, what if India experiences a Japan-style lost decade? But history shows us that Japan's long stagnation happened because the markets had surged excessively beyond the earnings growth during the 1980s. That created an unsustainable bubble. For India, we are still in broad line with the earnings growth. But if Sensex continues to deliver supernormal return without matching the underlying earnings growth, we could see a phase of slower return ahead of us. The key takeaway: as long as earnings continue growing, the market will eventually catch up. If the markets have surged too far ahead, expect a correction or a stagnation. The best strategy: invest based on earnings trend, not short-term market fluctuations. So where do we stand today? Are we overvalued, or do earnings justify the current prices? Please let me know in the comment section your own experiences, your ideas. I would love to learn from you. So the profit from the pit framework becomes even more powerful here. Mathematically, a recovery always gives a higher percentage return than the fall. If the market drops 30%, you need 42% gain just to return to the peak. Market recoveries are fueled by earnings growth. So if the market falls but earnings continue to grow, a comeback is inevitable. The best return happens when the fear is highest. The biggest mistake investors make is waiting for the perfect bottom. But you only know the bottom in hindsight. By that time, it is obvious that the markets have already bounced back. So if you enjoyed the content of this video, please consider liking it, sharing it with your friends, and subscribing to this channel.